Hello, everyone. This is Drew from Best of Us Investors, working with Mark on the Platinum Trading Platform. So Mark has been investing for over 40 years now and has worked as the director of operation for an online firm for about 10 years. He will be doing overviews on what he saw in the market in general and charts from the previous week, and also talk about some stocks or what he sees in the upcoming week. Now, for real-time buy, sell signal notifications based on more than 7 indicators and insights on stocks that are setting up for great trades each day, along with educational videos on how to read charts, come join our Platinum group and let's get through this tough market together, seeking for great swing trade opportunities and even for great potential entry points for long-term investments as well. So make sure you check the link in the description below for the Platinum membership. And I just wanted to remind you that this video is not made for financial advice, but for educational purposes only. So, Mark, how was the market last week?
Well, we're recording this on Friday, so it is we're still in it today. But as you know, it was an interesting market. How did you like the market? Because again, this is probably your first time going through something like this.
Yeah, so I mean, I always ask you a lot of questions about the market, and based on your chart analysis, I, really focus on what you say, and I'm getting more and more surprised on how the market really moves based on the charts. And before I learned how to read the charts, it was like it seemed to me like a random move, but now I think it does help me on, my future investments.
Right. The charts, I mean, the charts come from the market. So we have our trend lines, short and long-term trends. We have momentum. We use the MACD, which is a convergence, divergence. And so they're not always accurate, and they cannot predict, black swan events or news events like we had this week. But we know they're coming. Like CPI report comes out, like Powell comes out and speaks. We know that jobless numbers come out every Thursday, and those affect the market. Okay, that the charts really don't know that those are coming like we know that those are coming. So it does affect the market. This week, we had no really good setups for swing trading. So we basically stayed out. I stayed out because you can see what happened to the markets. And I'm glad that the charts helped me to stay out of the markets this week because it was pretty much a downward trend all the way. And it looks like it's going to go further just from the way the charts look. So you can see I put a line right here, and this is last Friday. You can see we went up last week. We went over the 200-day simple moving average, and we came back down. So on Monday, you can see we really had no news whatsoever. Everyone was anticipating the CPI report and the Fed coming out on Wednesday. So we went up about 50 points in the S&P. We closed just under the 9-day simple moving average. Then, of course, we came out with the CPI data on Tuesday, and the market went nuts. You can see we opened up way up here, and I think the Dow went up 900 points. The S&P went up because the CPI came in cooler than expected. So everyone expected that the Fed was going to now pivot or start reducing rates because inflation's over, even though we're at 7% inflation. I think the market is just a little too hooked on hopium and don't realize that the Fed looks at more than just inflation, and that we're still way above the 2% goal for inflation that the Fed wants. So you see price action gapped up. We had a high of 4,100 and we closed at 4019 down here, just below the 200-day simple moving average. So we could not maintain the 200-day. The 200-day is a great resistance point, as you can see. So the next day was, Fed Chairman Powell came out and talked about we're going to raise 50 basis points, which everyone expected. You can see we gapped up. And then when he started speaking about basically that they're going to raise the peak for inflation to 5.1% and they're going to hold it for a longer time, you can see what happened. We dropped down. We even gapped down to the 20-day simple moving average. And we had a high of about 40.53 and we closed at 39.95. So we closed under the 4,000. And then yesterday, just to top it off, you can see we gapped down yesterday in the SPY. We're now below the 9-day and the 20-day simple moving average. November retail sales came out and they were down 0.6%, which is more than expected, which economists think that means that Inflation is finally hitting consumers. 65% of people in the United States live paycheck to paycheck, so inflation really affects their spending. So that wasn't good news. Then we had jobless claims, which were actually good news because the jobless claims came down by 20,000. And normally in normal times, that would be good news. But in these times, that's bad news because the Fed wants unemployment to go up, basically, and that's not good news. So people know that's not going to help their case in trying to see if the Fed will reverse or pivot. And then the ECB came out and they raised rates 50 basis points, and they also talked about how long that they were going to have to raise and can stay correlated with the Fed. So we had a high of 39.58 and we closed at 38.95. So now we're below 3,800 on the S&P. And of course, today you can see we gapped down. We opened up underneath the 50-day simple moving average. So we are just sliding straight down in basically a falling knife pattern. We opened at 38.90, and currently, as we speak, at this time we're at 38.20. So again, the signs on the MACD are down. We look at the Scholastic, it's down. We look at the RSI, we're at 40. It's just not looking good in the S&P. Let's go over and take a look at technicals on the S&P, and I'll show you what I look at. So what do you see on this chart, Drew?
I think I see a double shoulder pattern that will head a lot down from this point.
There's a lot on this chart, and it's overwhelming. That's why we did the SPY, just to show you the trend in price action. But on this chart, you can see we have right here, we'll start at the top. This is a downward trending bearish line, and this goes back to January or further. And every time we've hit this line, we've been rejected over time. Let's just go back. Here's a year. You can see the line all the way back to January. Every time we hit, we get rejected on this chart, and we hit it again. So coming back, we came up and we hit this on the 13th of December, you can see, and then we got rejected. This is an ascending wedge, which we talked about before, these blue lines, okay? Ascending wedges are bearish patterns, and you can see when you hit and you break through an ascending wedge, which we did and came back up, now we broke through it again. Here's the 200-day simple moving average, which also acts as resistance. You can see we've gone above it a few times. We just can't get past it. And then the last thing that we're looking at right here, this is called a double top. Okay, this is also a bearish pattern. You can see that we've gone up. We hit a top here, couldn't get past that top, and that was almost right on the ascending wedge resistance line. We came back down, bounced up, and came back to about the same level on the top. So again, we came up, we bounced off this bearish line this time, which acted as resistance, and we came right down. And this is the neckline, okay? The neckline is the distance between where we start out on this pattern. And if we cross back over the neckline, and I said we'd probably see a little bit of a retracement, which we didn't, that if we get past and close below this neckline, then we're going to see further price action down. And the way you measure that is we go from the top of one of the peaks down to the neckline, and you can see that's this distance right here. We put that on the line, and you can see we're going down based on this pattern to a little above 37.80 on this pattern. And this is where we are today. You can see we're now down below the 50-day simple moving average. We're also, this is my gap line. You can see we had a gap right here that we're going to fill. Basically, we're almost filling that gap. So the gap is being filled also. And I have a feeling we can get down to 37.80 at some point. And we might have some retracements like we have here because markets don't always go down. Usually after 4 days, you'll see it pop back up. But I'm looking for the S&P to continue to slide down unless we have some amazing reversal with the Fed or some other news. But again, the MACD is dragging down. You see the Scholastic is dragging down, and you see that our RSI is in the 40s now, below fair value. So it's not looking good on the S&P. And then we can see the same thing without all the lines on the NASDAQ. You can see we're gapping down the same 4 days. Here's our 200-day simple moving average. We haven't even really got up to that point. So that, again, we're looking at the MACD, the Scholastic, that's going down. And our best performing was the Dow Jones. And you can see even the Dow Jones is now coming down. We did have a golden cross here, which isn't helping us much, but we're very close, less than 2% away from this 200-day simple moving average. And if we cross that, the Dow will be in bearish territory also. So the only position we've been watching over the last week or two is Procter & Gamble. And you can see it got above its 200-day simple moving average. It's just been plugging along, even with the market doing what it did all the way up. And this was yesterday with our big dump. It still closed above the 9-day. And today it looks like it's finally going to close below the 9-day simple moving average. And if you were in this trade, this would be your signal to probably get out when one full candle closed below the 9. If you wanted to hang in and let it bounce off the 20 and see if you could catch a bump back up, you could do that. But if your risk tolerance isn't that strong, then you would probably want to get out at this point. So there's really not any good setups at this point when the market's going down so drastically for swing trades. And that's okay, because swing trading is about making money, and you don't make money when the market's going down unless you're shorting the market, of course. But in our swing trading, we're trying to make money as the market goes up. This will provide us with some good setups. And we looked at energy this week, and energy fell apart. And in fact, if you look at all 11 segments of the S&P, Drew, they're all down trading below their 9-day simple moving average. So this market sell-off is a vast market sell-off covering just about every type of industry and sector that we can find. So we're just going to sit on our money for a while and let the market come to us and be patient so we don't lose money. We want to make money.
Wow, Mark, that was a lot that happened in the past week, especially with the CPI and the FOMC meeting. Thank you for going over that and correlating with the market as well. Again, it was really helpful for me, and I hope it's helpful for the subscribers who are watching this video. So thank you very much all for listening, and I hope, again, you guys all enjoyed this episode. So for more details and updates regarding swing trades and chart analysis each day, make sure you join our Platinum group, and let's successfully invest and make it through this tough market together. See you all next week again. Thank you.